It's time to bring in focus, the feature on the show today. Now, the overall market decline resulting from a worldwide reaction to COVID-19 signals and low oil prices shows that private equities investments will need repricing. In evaluating the nature and extent of the impact on businesses, income, forecast, and valuation assumptions, considerations now focus on facility closures, reduced customer traffic, supply chain interruptions, production delays, and impact on human capital, regulatory changes, as well as risk of loss on significant contracts. As comparable companies' metrics are on a lagging basis, market multiples will be depressed relative to historic multiples. For the bond and stocks market, there has been a gradual return of new issuance by companies and other institutions as they need cash to maintain their operations. Meanwhile, the full impact of the sudden standstill of the economy is not yet fully absorbed by the capital markets. For the current oil pricing levels, the impact on businesses, product costs remain largely heightened. Hence, developing a renewed focus on reforecasting and modeling cash management and normalization of market data is the way to go. Joining me now live in the Lagos studio to discuss this much more is an investment professional, Mr. Robert Omotunde. Thank you very much for your time, Mr. Omotunde.
Thank you.
And
Thank
it's
you
been a while. Thank you for joining us
while.
today.
It's been a while. Thank you.
Let's quickly start with inflation. That's the latest, 12.82. Were you expecting that?
Well, I was expecting that, yes, there will be an increase, an uptick in the headline inflation. And the reasons are not far-fetched. You can see that since the advent of COVID, even before COVID-19, we've had our own pressure points on consumer price index. You know, the initial was food prices, which continue to rise on a month-to-month basis. And from the result, you can also see that by classification of individual consumption by purpose, which you read out, you've seen that there have been uptick across major line items, you know, comprising the headline. You know, food not an exception. And the reason for this is also because, you know, some of the, you know, consequences of the so-called lockdown, you know, COVID-19 pandemic is that we are beginning to see pressure coming from farm produce as well, where farmers cannot, you know, produce as much. And, you know, it's a demand-supply thing, right? So when the production, you know, when we are short of production, you know, with demand still rising, what you then expect will be that prices, you know, there will be an uptick in price. Now, on the other hand, most of the imported products, you know, are, you know, one way or the other, either now scarce or very expensive. You know, because of course we've also seen depreciation of the currency. You know, if you look at the movement, the real official, or so to speak, market-based exchange rate has moved by about 20%, you know, 23% or thereabouts, you know, over the last 6 months. So this also means that for imported products, you will see the impact. If you've visited supermarkets, I have visited supermarkets, and products that I would naturally pick at a lower price, you know, are now, we can already see upticks in them, meaning that the effect of the imported inflation is also being felt on domestic prices. It's going to get worse, and we should get prepared for that. You know, the reason is because there are so many other pressure points. Now, the government has just exited the payment of subsidy, which is a good one, especially now that government revenue fundamentals would not support, you know, continuous subsidy payments. Now, what this means is that for, you know, every month you will see the PPPRA coming up with new templates on the basis of exchange rate pricing, as well as the so-called crude oil price in itself. You know, and if you see, you know, we've suffered a significant decline in crude oil prices, you know, at the beginning, I mean, towards March, going into April. And then you've seen gradual uptick. As we speak, oil prices are hovering between, you know, 43 to 45, you know, dollars per barrel. Now, what this means is that continuous pricing of or rebalancing of the pricing template will mean that, we'll see uptick in the pump price. And pump price is an energy source that has significant implication on the headline inflation. So the reason why we should get well prepared, if you see oil prices moving towards the $60 per barrel, then you will see the impact on pump price, which then feeds into our headline inflation. The good news, however, is that it's good and it's bad, on the, still on the energy side, on the electricity side. Government, the National Assembly has said that they are moving the tariff till 2021.
Indeed.
Although the sad part of it is that, it's not going to impact on inflation. That's good. But the sad part of it is that we are further delaying when we can, begin to have constant electricity. Because what is happening right now is that people are, electricity companies are not getting what is even close to the
cost-reflective tariff
of
that
producing
we've argued for years.
Yeah, exactly. So inflation will keep rising. My conservative outlook is that it might settle around 13.5% by the end of the year.
Wow, 13.5%.
Yes, it could actually be worse if electricity tariff should kick in. We may see it getting as high as 15%.
I'm really worried because all of these issues seems to be interwoven
Absolutely.
one way or the other.
Absolutely.
Because when we talk about the value of the currency, that's something that the central bank is yet to even come out to tell us where we stand. There was a we call it devaluation, of the naira at the moment. Are you sure the naira is really appropriately priced at the moment?
Well, I wouldn't say that the naira is still appropriately priced. And remember, we've argued severally. You can understand the position of the central bank in that they know the significance of, or if you say the transmission mechanism through which exchange rate feeds into the overall economy.
True.
It's very potent. The first line, the way you see it is in your inflation. Which I just alluded to in the fact that, imported inflation is also rising as part of other line items that are rising, contributing to the headline. Now, the point is that the central bank would, from its own position, want to maintain that exchange rate stability. But in some way, the central bank is handicapped because there are so many factors pressuring exchange rate at the moment, right? Now, we have an economy where the interest rate environment, it's, if you like, is mispriced, because you see all of the risk factors, the fact that oil prices are low, government revenue fundamentals are not strong, yet you have a situation where interest rate environment is so low. Check Treasury bills rates. 1 year Treasury bill is barely yielding 20%. 2% today.
2%.
And then you look at the OMO rate, which is also supposed to attract foreign portfolio investment, and you're seeing rate at 3.5%, 4% at the longest tenor. So definitely, central bank is possibly aware of who are the category of people playing in that market right now, because between you and I, we will both agree that a 3.5% or 4%, even a 5% OMO rate will not attract foreign, portfolio investment at the moment. So one of the, consequences of this is that we are going to suffer a bit of what economists call sudden stop, where you don't see foreign portfolio inflow into your economy anymore. So that means that source of, reserves accretion is going to be significantly affected. Now, the other leg is to have oil prices, at a comfortable level, that helps us to build in the reserve.
Yeah.
But that again is being pressured. The level at which we were, before the year started is not where we are currently, even though we've seen some form of recovery, so that is also going to suffer. So now, the combination of all of this will mean that foreign direct investment, of course, has been significantly, low, over the last 10 years. Now, some of the policies that can help, improve that inflow is what government is just trying to come up with, a number of subsidy. If we succeed in doing that for electricity as well, and we create more enabling environment, then we can see more inflow from the FDI side. Yeah. But now the consequences of all of this put together will then mean that the reserves will continue to deplete. Now the demand are rising. There are still some foreign portfolio investment within that will possibly like to exit. What that means is that if they cannot get sufficient dollar to meet that demand, it continues to put the pressure on the rate. And that's why you will see, even though we claim now that all rates are aligned at the official window, no CBN rate, no SMIS rate, no, I&E FX window, more or less now, aligns all of the rates. But that's still at 386. Look at the gap between 386 and 470, 475 in some instance at the parallel market. What does this suggest? It suggests to us that the demand-supply mismatch is still existing. True. And what that means is that, I am more aligned to what the parallel market reads in terms of that balance, because what you see is at the I&E, not everyone can participate at the I&E. Remember the 43 items, which has now increased to 44 items, cannot access FX at the I&E FX window. They go to the parallel market. So what it means today is that if you have to converge all of the rates, all of the demands and supply for both markets today, and you allow everybody to participate, you would then see that 386 is not the true reflection of demand-supply condition for exchange rates. My bet is that perhaps exchange rate is most fairly priced at about 450 naira to the dollar. And this is also evident in the forward rate. If you check the forward rate, 1 year forward rate, which is also an official window, you will see that exchange rate is around 455, in some instance 460, for 1 year delivery. So this suggests to us that currently at the I&E FX window, the exchange rate may not be appropriately priced.
Now let's look at investments now, which you're a special, that's your specialty now. You talk more about other economic issues too, but can you now say, when will this country become that when can we attract that kind of investment that we need with all of these challenges? I'm looking at that time where people will now say, oh, I'm heading to Nigeria with my portfolio. I need to do some business. Yeah. When are we going to get to that point?
We need to go back to the drawing board. I mean, COVID-19 forced certain things on us when we suffered that revenue shortfall. Then you saw IMF demanding, World Bank demanding that Nigeria should take certain reforms. Yeah. That was what bettered the so-called removal of subsidy. You remember, we've been shouting about subsidy removal for more than 5 years. The last economic recession we suffered in 2016, we wasted the opportunity to remove subsidy. I'm glad that we didn't waste this particular one and we've removed subsidy. And, we've argued severally that subsidy benefits the rich more than it does the poor. True. Now, there are several other reforms that we need to take. I am positive that the removal of subsidy will technically open up the oil and gas sector for more investment, but the power sector is another. Our policies must ensure that the business environment is enabling. That is when we can now be that destination for capital attraction. That is when the whole world will now say, oh, like you said, I'm heading to Nigeria. Yeah. Because not just are you looking at the returns, you're also looking at the risk profile of the environment you want to invest. Risk and return are two things that, any investor will want to think about. So I won't just think about the return. I won't say, okay, coming to Nigeria gives me 30% returns and then forget about the risk. The risk is that the 30% can disappear in my very eye. True. And I can even go to the negative. True. So, and because we need to de-risk our investment environment before we can then begin to attract those capital, government has a lot to do.
I'm going there. Yeah. Government, please. There's a lot. Policy options. Let's round up with that. Policy response that they've done before now, and what more can be done. Now,
in terms of policy response, you can never get to the point where you just feel, okay, maybe I'm okay with what I've done so far. You have to keep, because the investment climate is changing globally, and don't forget, it's a competitive world. Nigeria, even when you look at Africa, frontier African markets, Nigeria is not the only country. We may be the biggest. True. There are several other countries. When they position themselves in a way that can attract those capital, they will fly over Nigeria, go to those countries and invest there, get the returns with minimal risk. So what it means is that government must constantly, I mean, one of the things we're trying to do, which is under the, purview of the vice president, is enabling businesses, But I think what more we need to do is that there has to be political will. Think about it, I mean, you read out in your news that so far in the year, we've spent only about 400 billion on capital expenditure so far in the year. Whereas on debt servicing, we've spent over 1 trillion. So how sustainable is that? It means that for us to then get to the level where we invest more capital, estimates are running into hundreds of trillions of trillions of naira that we need to spend to get, our act together in terms of infrastructure. How much can the government do when you're spending it's beyond half year. True. So by the end of the year, we'll be lucky to get 2 trillion spending on capital, which means that the government should agree that they can't do it alone. So one way to do it is to then say, okay, let's create that enabling environment for private capital to flow into the country and help us develop the critical infrastructure that we'll need, so that Nigeria becomes an investment hub. If you disaggregate our GDP, by consumption, investment, government, and net export, you will find out that consumption still account for a larger chunk. Countries like China will have investment accounting for a significant part of their GDP. That is the phase that we need to. We shouldn't just be a consuming nation. We should be a nation that is also growing because we are investing a lot. Look at our manufacturing sector, and the dilapidated state of our infrastructure in the manufacturing sector. These are things that we need to, put together. It's a lot of issues, so there has to be a comprehensive plan that is being followed, government in, government out, because that's another issue we have.
Yeah, true.
You have another government, and then you discontinue the plans or programs of the previous government, and then politicians should also understand that government has to be a continuum. When we have a plan, in as much as those plans are well detailed and drafted, we should follow the plans through so that we can implement them, and then it could help us to solve a lot of the investment issues.
Mr. Robert, but today it's always nice having you on this
Thank you
show,
very much.
and I feel like we go on and on, but this much time can take. I must thank you very much. Investment professional, sharing your Monday with us and breaking it down on Business Nigeria. Thank you. Hope to have you
Thank you
shortly on the show again.
Thank you.